Okay, so you heard the latest numbers. The latest retail sales report just dropped, and yeah, it's underwhelming. U.S. retail sales rose by only 0.2% in September, falling short of the consensus 0.4% gain and down from August's 0.6%. And at first glance, you might say, oh, consumer spending is still positive. And yeah, you're technically correct, but context matters. This was delayed data backlog because of the shutdown, and the underlying signals are weak. Restaurants and gas stations saw upticks, electronics, clothing, and online retail fell. Here's where it gets interesting for mortgages and housing market. If consumers are tightening up, spending selectively, then the chain starts to stretch. Less consumer strength means less hiring, weaker income growth, and when that happens, it hits housing, it hits mortgage rates, it hits real affordability. Now let's tie in the Fed because, yeah, they're watching this too. With the unemployment rate sitting at 4.4% and hiring sluggish, the Fed is caught between a rock and a hard place. Cut rates and risk inflation again, or hold off and risk a slowdown? Either way, they're under pressure. So what does this mean if you're buying, refinancing, or holding real estate? First, don't assume the trajectory is smooth. This dip in consumer activity could lead to rate volatility. Second, the window of good for buyers might widen, but it won't stay open for long. If incomes weaken or credit tightens, that advantage disappears fast. And third, structure matters. A great rate today might still be risky if the economy and job market wobble next year. This isn't fear. This is seeing the pattern. The headline is sales up slightly. The reality is consumers coping and not spending freely. And that matters more for rates and real estate than it might look at the moment. If you want to walk through how this affects your mortgage strategy and buying power, message me and follow me to master your mortgage.